Welcome to this week's edition of Trade the Trend, a weekly video about where the stock market is going. This video is going to focus on the S&P 500. I'm going to cover the ASX 200, gold, copper, and uranium in a separate video, and I'll leave a link for that in the description section below. I'm also going to have a look at the Dow and the Nasdaq, so make sure you stick around for that. As always, this is general commentary. It doesn't take your personal situation into account. With all of that said, let's get into our first chart. So we've got the S&P 500 up on the screen, and things are really starting to heat up over the last week. The bullish scenario that I've been speaking about over the last probably several months now is starting to get tested, and we have the S&P 500 pulling back towards these moving averages. So what I want to do, I want to look at go through some of the major indices, the S&P, the Dow, the Nasdaq, and look at the structure and consider how we should be managing, or how we could be managing this current situation. So let's start by having a look at the hourly chart for the S&P 500. Just get a little bit of detail on the most recent price action. What I want to look at, I just want to look at the last couple of days. And we can see that each time the S&P 500 has made a new low, there's been a quick snapback in the opposite direction. And again, on Thursday in the US, we had a new low, and then we had a snapback in the other direction. Of course, I'm filming this on Friday afternoon in Sydney, so we don't have Friday's price action for the US yet. But this sort of price action that we've been seeing over the last couple of days, it does suggest there that maybe this sell-off from last week is now starting to run out of steam, and maybe we are getting close to a point where we're going to get some sort of rally in the opposite direction. Tentative signs of buy the dip, very early days. We want to see how this continues to develop, but maybe we are going to see some sort of bounce develop over the next couple of days. Moving to the just coming back to the daily chart, and what I want to look at here is, let's start by putting on some Fibonacci retracements just of this rally from the December low going up to the recent high. And what we can see at the moment is that this pullback that we've been experiencing, it's right back into that Fibonacci region now, right back at the 50% mark. And so far, I would say that the pullback from the February high, it does seem to be in proportion to the rally we saw from the December low. So from that perspective, it's looking like a typical corrective sort of pullback. And we've also got this strong support level coming in through here at around 3,900. Just beneath this Fibonacci band. So the bears still have a lot of work to do, I think, if they're going to turn this around and start to send this market back to a new low. Another thing I want to do, I want to put on an indicator. I want to put on an advanced decline line. So this is the advanced decline line for the New York Stock Exchange. So of course I'm comparing it to the S&P 500, so not the same thing, but the price action aligns with both. And the point I want to make here is, so far the advanced decline line, it is pulling back, but it looks like a pullback. It doesn't look like a turnaround in this momentum we've seen in the advanced decline line from the October low. And what's been interesting, just over the last couple of sessions, you can see the advanced decline line made a low on the 21st. Which is, it's a few days ago. And the SP 500 has continued to decline, but the advanced decline line has been edging higher. So only a really short-term analysis of like the advanced decline line, but even just in this short time frame, there is a little bit of divergence coming in where the advanced decline line is rising while the S&P has been declining. So I think internally this is a positive sign for the market. It's a sign that I think it's a sign that the this may well be a corrective pullback from the high. So it is, look, it is an encouraging sign. But I think like a big point I want to make here is that if these levels that I've been speaking about, the Fibonacci's, the 3,900, if these levels start to give way, the market starts to fall down, break below these moving averages. If that happens, then I'll close down risk. I'll reverse my positions. Well, I won't necessarily go short, but I'll certainly close down long positions. I think a mistake that a lot of people make in these situations is that they have a view. And my view, as you know, over the last several months is that this market can continue to experience upside, not necessarily a new bull market, but I want to see where this momentum takes us. And when people go on the record, they say things publicly, they go on YouTube and they say, look, I think the market can rise. They then feel they've got to defend that position. And even in spite of maybe the market falling away, they'll defend what they've previously said. I don't do that. If I'm wrong, I'm happy to say, look, that hasn't worked. I'm going to say the opposite. I'm going to say, look, I think the market's now vulnerable. I think it's now falling. I think that's some hallmark of anyone who's going to have success in the market. They don't get locked into a view. They're flexible in their thinking, their approach, in their positioning, and they can walk away from positionings and a viewpoint when it's not working. So I'm happy to abandon this notion that the market can continue to rise if the price action suggests otherwise, if we start breaking below these key levels around 3,900, maybe below 3,800. At the moment, that hasn't happened. So I think for now, it's a case of giving the upward momentum that we've seen the benefit of the doubt. I'll be looking for price action, maybe sloppy sideways price action, not a really strong buy the dip type of price action. And then if the market starts to roll from there, that's when I start saying, look, maybe we do need to look at the possibility that the bears are right, and we do retest and break this October low in the months ahead. But let's just watch the price action, keep an open mind, because it's not clear cut by any stretch. Now, if you're getting some value from this, please hit that like button. Please leave a short comment. Just, hey, thanks for the video. It just tells YouTube people are watching, people are engaging. YouTube shows more people, which helps me a lot. And subscribe if you haven't already done so. Just clicking that button below the video. And so please do that. Please hit that like button. Really big help. Now let's jump over and have a quick look at the Dow. Dow's been interesting. It's been pulling back as the rest of the market has. But this is a scenario that we've already spoken about. We've been speaking about this scenario for at least 2-3 weeks now. We've got this overhead resistance in the Dow around 34,400 to 34,000. This blue shaded area. Been quite a bit of technical activity in this region over the last year or so, and it's not surprising. The market has been capped. It has stalled here. Also got the Fibonacci region, which is from the October low to the recent high. And one of the scenarios which I was talking about, I think it might have been 3 weeks ago now, I said, look, it may be possible that we see sort of like an ABC, so an A, B, C type formation or structure start to form, where the market does come back and retest the Fibonacci's. Looks like that's what we're doing now. So as it stands, looking at the Dow, this remains a constructive price action. It's not price action that suggests the market's about to plummet and break to new lows. Yes, that could happen. Yes, the structure could change, but at this point, the move from the December high looks corrective. It looks like an ABC zigzag correction back to a Fibonacci zone. So keep an open mind with this, and don't be too quick to throw out potentially profitable positions that you may have. We are having this decline. Declines are all part of the process, and we are below the moving averages. And one of the things I often talk about, trouble happens below moving averages, but it's below declining moving averages, which I get concerned about at the moment. This is a dip below rising moving averages. Just to give you an example, I'm just going to go back to a period in 2016. So just this period here, we had a strong rise off lows. We had a sideways consolidation. Market had a sharp dip below the moving averages and then sprang back. That can happen in a rising market. It's not unusual price action. The price action I worry about is when you have declining moving averages and you have prices sitting beneath the moving averages. That's when the bad stuff often happens, as it did on that occasion in 2015. But that's not the price action we have at the moment. We have price action which is rising moving averages and pulling back to a Fibonacci zone. So let's just continue to monitor this price action in the Dow. And just quickly finishing up with the Nasdaq, similar story to last week, where the Nasdaq is working off a strong rally we had off the December low. We had a situation where in early February the market had become quite stretched above the moving averages, and so the pullback that we're seeing now, it's pullback in itself is not unusual. It's not surprising. It's something that we've spoken about. Now, I pointed out 4 positives last week, and they're still in place. And those positives remain that the moving averages, the 50 and the 100-day moving averages, are trending higher. Price is still above those moving averages. We have a market which has broken above the resistance point at around 12,000. And that resistance is now support, which the market is sitting above. And we've got this reversal pattern, this bullish wedging formation, which the Nasdaq broke out from in January, currently pulling back towards that breakout point. They're the positives I mentioned last week. They're still in place despite the pullback that we've had in the last week. Now, of course, this does not guarantee a bullish outcome by any stretch. And this is a thing, nothing in this business is guaranteed. That's why we use risk management strategies. If this move up from the December low fails and this market, which is rolling over, continues to gain momentum to the downside, it's not about digging in and saying the market has to go back up because of those factors I just mentioned. It's where we use risk management to protect capital and step out of the game. And these videos, they aren't about predicting what will happen. They're about trying to identify possibilities, possible pathways for where the market could go, and then using those risk management strategies to manage those possibilities. I know this is a difficult time. It's a difficult time both analytically and emotionally. There's a lot of cross currents of opinion, of price action, and it's hard. Lots of strong opinion that the market has to go lower because of the fundamental picture that rates are rising, and we know the story well. And maybe that will happen. But at this time, I think it's still a case of maintaining long positions that have been working. Not about holding long positions that have been falling for the last 12 months. It's about holding long positions that have been working over the last several months, giving the momentum the benefit of the doubt, seeing if these support levels do hold and if the market can rebound. If it doesn't rebound, if supports break, cut positions, move more into cash, take a more defensive stance. But that's not the situation as it currently stands. So let's leave that there. Hopefully that's been interesting. Hope it gives you a few ideas for how things could play out over the next few weeks, next few months. So thanks for joining me. Look forward to coming back, talking to you next week. Until then, bye for now.